My name is David Goodman. I'm the director of the China Studies Center in Sydney. And before we go any further, I should welcome you in the traditional way for Australian universities now. I'd like to acknowledge the traditional owners of Australia, recognise their continuing connection to land, water and culture, and to pay my respects to their elders, past, present and emerging. Today, we're very, very pleased to have one of the world's major economists of China, economic authorities on China, Michael Pettis, who's going to come and talk to us about the evolution of the Chinese model. We're also very pleased that Glenda Corporal, who's from the Australian and has spent much time in China, is going to chair the session. In a minute, I'm going to hand over to both of them. But before I do that, I just want to say that when you want to ask questions, please do it by writing in the Q&A box at the bottom of the Zoom screen, so that Glenda can moderate the questions that are asked later on to Michael Pettis. Because we started late, we will go until 6:10. Over to you, Glenda.
All right, thanks very much, Dave, and glad we could connect up. I'll just introduce you to Michael Pettis. He's a finance professor at the Guanghua School of Peking at Peking University, and he's a senior fellow at the Carnegie-Tsinghua Center. He's lived in China for nearly 20 years. Before moving to China, Pettis spent 15 years on Wall Street, running fixed income trading and capital markets desks at JP Morgan, first Boston and Bear Stearns. And in that role, he advised governments in Latin America, Asia and Eastern Europe on debt and balance sheet strategies. During the last 9 of these years, he also taught finance and economic history at Columbia University. Now, he's published over 200 articles in leading periodicals and 6 books. His most recent book, which was published by Yale University in 2020, is called Trade Wars Are Class Wars, and the subtitle is How Rising Inequality Distorts the Global Economy and Threatens International Peace. That won the Lionel Gelber Prize, and in addition to that, he also has an MBA in Finance and an MIA in Development Economics from Columbia University. So with that, Michael, we'll hand it over to you. You've been in China for 20 years. What do you see as the state of the Chinese economy at the moment, and what are the forces that you've seen that have shaped it?
I think the important thing to understand about the Chinese growth model is that it's not particularly Chinese, it's not particularly new. It's a growth model about which we have quite a lot of experience. You could argue that it was invented in the 1930s in the Soviet Union and in Germany, but it was really sort of perfected by a number of economies. At least 24 economies have followed this growth model since the Second World War. And what I would argue is that this is a model that depends on high investment and high domestic savings. And the way you raise the domestic savings rate is by high savings is just the obverse of low consumption. And so in order to reduce consumption, what you do is you reduce the income of those groups that are most responsible for consumption, which are, of course, households. Governments consume a little bit, businesses don't consume a lot, households do most of the consumption. So if you reduce the household income share of GDP, you can boost household national savings, that is household, government, and business savings. And if those savings are directed into a controlled financial system, those savings can then be used to increase investment. Every country that's followed this model has basically done that. Now, is this a good model or a bad model? Well, the answer, like the answer to almost any question in economics, is it depends. Most of the countries that have implemented this model have started at a period in which investment was extremely low. So, for example, Japan after World War II, Brazil, a number of countries in Latin America followed this growth model. And China, after 50 years of anti-Japanese war, civil war, and Maoism, was also a country that was significantly underdeveloped for its level of social development. And as a result, this was a great model, because what it did, China at the time had no bridges, no airports. It had 4 airports in the whole country. It had no highway system, no subway system, et cetera. It needed everything. So by forcing up the savings rate to what became the highest savings rate in history, and pouring that into the banking system, which was then made available at very low interest rates, often negative real interest rates, to local governments, to local manufacturers, it was able to increase investment at the fastest rate in history. Now, this is always a good thing when you're underinvested and investment is going into areas that increase the productivity of the economy. The problem that every single country that's followed this model has had, without exception, is that with these very high investment rates, they close the gap between the amount of investment they need that they can productively absorb and the amount of investment that they have. And when that happens, in theory, you're supposed to switch to a different model, a model that really allows the productivity of workers and businesses to increase. And that really involves a change in political, business, financial institutions, et cetera. But no country in history has ever been able to do this. And what ends up happening is they continue investing at a very rapid pace. The whole economy is built around the need for rapid investment. But now this investment is less and less productive. And as that happens, debt, which was always rising, but GDP was rising just as quickly, we start to see a split between the two. And debt starts to rise more quickly and GDP growth more slowly. So you start getting an increase in the debt burden. And in China, this happened probably around 13, 15 years ago. And we started to see debt really take off. So this is sort of where China is. It's in this position where it cannot achieve high levels of growth except with high levels of investment, which means a great deal of non-productive investment in infrastructure and in the property sector. And as a result of very, very rapid growth in debt. They know they need to address this, but they want to address this without a slowdown in growth, which is almost impossible. So we're still figuring out which way to go.
I think you've identified the problem. The hard way is for them to work through that, because we have seen the pictures on the television of these huge towers of apartments being exploded, and as you talk about unproductive growth. And then we've also got the Evergrande situation people have been following. So I suppose the question is, can they do it? Can they reduce this unproductive investment in a sort of subtle way, in a way that doesn't sort of threaten to cascade downwards, I suppose. I mean, we've all heard the coming collapse of China, and China always defies those predictions. But the point is, can they do it? Can they sort of muddle through, or just tap the brakes enough to slow things down to a more sustainable economy, or is that still up in the air?
Well, in principle, they can. No country at this stage has ever been able to do it, but that doesn't mean it's impossible. So the way I think about it, there are literally 5 paths that China can follow, or some combination of those 5. One path is to keep doing what it's doing now. And this year, we're going to do that. Already, the National Institute of Finance and Development said they expected the debt to GDP ratio this year to rise by 4 to 5 percentage points. I think it'll be a little bit more. The local governments, about 2/3 of the local governments have announced, all the local governments have announced their growth targets for the year, but 2/3 of them have also announced how they're going to go about achieving it. And nearly all of them, the growth in infrastructure spending will be greater than the expected growth in GDP. In other words, they expect investment to lead the process. So we're back to the same old model, but they recognize that this can't go on forever, because if it does, you need an infinite debt capacity. And so far, we've never been able to figure out how to get infinite debt capacity. So if you want to stop this, then you have to stop the investment in non-productive infrastructure, which includes property and infrastructure. So one path then is you don't stop it, you keep doing it, and debt goes up forever. The second path is you stop this non-productive investment and you replace it with another source of demand. Now, there are three sources of demand in any economy: investment, consumption, and then the trade surplus, which is net foreign investment in consumption. So the second path they can follow is reduce bad investment and replace it with good investment, investment in technology, investment in productive sectors. This is what they say they're going to do. And they've been saying this for many years and haven't been able to do it. And it's very difficult to do. And maybe later on, if you like, we can discuss why I think it's quite difficult to do. But at least in principle, they can reduce bad investment and replace it with good investment. The third path they can follow is they can reduce bad investment and replace it with a growth in consumption, much more rapid growth in consumption. The problem there is that consumption in China is very low because the household share of GDP is very low and the government share of GDP is very high. So the solution to that problem is quite obvious. You have to switch a significant amount of income from local governments to the household sector. Now, that's easy to say. Politically, it's incredibly difficult to do, but at least in theory, they can do that. The fourth possibility is they bring down bad investment and they replace it with a surging trade surplus. If you're Singapore, maybe you can get away with this. The second largest economy in the world can't get away with it. The world simply cannot absorb that size of a trade surplus. So that's pretty much a non-starter. And then the fifth path is you reduce bad investment and you replace it with nothing, in which case, by definition, GDP growth will drop very sharply. I suspect to well below 2 to 3%, but we don't really know. But that's literally it. Those are the options. There's nothing else they can do.
So I suppose this year obviously is a very big year in China with the 20th Party Congress, and you've got Guanghua coming up. I suppose there's two things. What might Xi Jinping need to do this year, and then what can he do in the longer term? So how much of this 20th Party Congress is sort of shaping economic policy at the moment?
Well, I think you're absolutely right, Linda. I think that because of the Party Congress, they're very limited in what they can do. And so it would be, I've been in China for 20 years, as you pointed out, and every time you have a party Congress, particularly one ending in 2002, 2012, and 2022, it has to be a great success. Everything has to go very well. So that's why most of us are, well, I shouldn't say most of us, there's been a shift, but I'm expecting growth between 5 and 5.5% GDP growth. The World Bank and the IMF have all downgraded. Goldman Sachs downgraded their growth expectations to below 5%. I think they're going to be wrong for political reasons. So it's very important for them to achieve this high growth rate. But Beijing distinguishes between high quality growth and the other stuff. They don't give it a name, but presumably it's low quality growth. In an essay in July, Xi Jinping referred to genuine growth versus inflated growth, which I think is the same thing. And high quality growth is basically the growth that comes from consumption, exports, and private sector business investment. The private sector only invests in things that they think are productive because they have hard budget constraints. It's the public sector with its soft budget constraints that invests in non-productive stuff. So the real growth, the good growth in China is this high quality stuff. And as I said, I don't think that that's likely to generate much more than 2 to 3% growth. So if you want growth rates above 5%, and I'm pretty sure they do, then you're going to need either a significant revival of the property sector, and we're going to see a partial revival of the property sector, and a significant increase in public sector infrastructure spending. And already it's clear that that's happening. As I said earlier, the local governments have all announced that they expect public sector infrastructure spending to grow even faster than GDP. So I think we're going to see that. So I think, because it's a political year, I think we don't have much of a choice. We're going to continue the old model. But it seems to me that quite a lot of the economic policymakers and advisors understand the problem. It took a long time for them, but I think they all understand the problem. You listen to Liu He, you listen to Li Keqiang, you listen to the people around the PBOC, and they all recognize the problem of debt and of misallocated spending and infrastructure. So when do they do something about it? My guess is probably after the party congress is more or less sewed up, which typically occurs in August, September. The party congress will probably be October, November. But I think around that period, we will start to see, depending on the politics, about which none of us has a very good understanding, but depending on the politics, we'll probably start to see them get more serious about cutting back on non-productive investment.
I just wanted to go, let's just have a quick chat about Evergrande, because in a way it's almost a symbol of the broader picture. How are they? I mean, everyone's watching it, and I think there's Oaktree Capital is looking at buying into some of the assets from Los Angeles. How are they managing it, and how does that play into their strategy of keeping up growth, but maybe cooling unproductive investment?
Well, the property sector and Evergrande in specifically has been a problem for quite a long time. There was a report that came out, you can find it on YouTube, I think, that came out as far back as 2012, I think it was, or 2015 on Evergrande, which was a real horror story. I mean, and we all knew that. We all knew that the types of activity they were getting involved in. But even though Evergrande and several of the other property firms were private sector firms, they acted like public sector firms in the sense, to use Janice Cornet's phrase, they operated under soft budget constraints. They didn't have to maintain liquidity because they got basically infinite financing from the banking sector. So that's a lot like the local governments. And as a result, debt exploded. Debt exploded much faster than profitability. In fact, you could argue that their profits consisted mostly of rising debt. And everyone's known that this has been a problem for a while. In addition, because of the very aggressive bidding by property developers, if you're given unlimited financing, then you are always better off buying. There's no cost to overpaying. There's a cost to not participating. So as a result, there are many people believe that that helped cause real estate prices in China to soar to really incredible levels that we've only seen before in Japan in the late 80s and in Spain before the great financial crisis among major economies. So they wanted to get control of that, and they did so with the famous 3 red lines, which were basically new regulations whose purpose was to prevent the growth in debt. Now, once you prevent the growth in debt, anyone should have been able to tell you what was going to happen, that the real estate sector, the most indebted property developers, were going to get into serious trouble. And sure enough, they did, beginning with Evergrande. Now, what a lot of people worried about was financial contagion. I'm sure you'll remember, Glenda, all the talk about a new Lehman moment, a new Lehman moment. Well, that was never likely to happen. China has a lot of experience managing financial contagion. Basically, they control the financial system, they control the liabilities, and whenever a company gets into serious trouble, they force, they get everyone together, knock a few heads together, and the problem is resolved, which is why China is very unlikely to have a financial crisis. And they've been practicing this basically since the intervention in Baoshan Bank in May 2019. So I think that was never likely, and I think the regulators were very confident that they could handle the consequences of a Evergrande default. What they got wrong, something that they're very unfamiliar with, is something that in finance theory we refer to as financial distress costs. That, I think, really shocked them. And the way financial distress costs work is that when the probability of bankruptcy goes up, somebody has to pay, right? You know, if I lend you $100 and you cannot pay me back more than 50, someone's going to lose $50. In a clear, well-functioning system, I will lose the $50, right? But in a very unclear system, there are many, many ways that that loss can be apportioned. And as a result, different players within the system have to change their behavior to protect themselves. And that, I think, is what really shocked the regulators. We started to see that suddenly banks became worried about lending generally to the property sector, so they stopped lending. Suppliers who typically deliver goods and get paid in 6-month paper were now saying, we don't know if we're going to get paid or not, so we will no longer deliver unless you pay us cash. Contractors were the same thing. We will stop construction until you pay us cash. Households, typically home buyers, put up cash up front near the beginning of the building of the apartment building, and then 2 years later they get delivery of the apartment. They started to worry, thinking, you know, we put up the cash, maybe we won't get the apartment. So of course home buying stopped, and fewer people put up cash up front. And as a result, all these things fed upon each other, and each one made the problem for everyone else worse. So you started to see that spiraling out of control that you often get in a bankruptcy process. And that continues to be happening. I think the regulators were really shocked at how vicious that process would be. But the latest data we have for January suggests that home purchases are way down, government sales are way down, particularly government sales to the private sector. The public sector has stepped in to buy a lot of the lands. And remember, local governments rely on land sales in order to generate revenues. So in some cases, local governments have created special purpose vehicles who borrow money under the government guarantee and then buy the land. So it's basically you buy the land from yourself and call it revenue rather than debt. You know, I don't need to tell you, that's really worrying. But that was the consequence of the real estate sector. Now, in my opinion, they're going to do everything they can to cause it to revive. And we can talk about that later if you like. But the real estate sector is just too big to allow it to close down, or to allow it even to become normal by the standards of other countries.
You know, you talk about the other elements of growth, consumer spending. I think the dual circulation is aimed at perhaps increasing the role of consumption in the Chinese economy, so it get a little bit more towards the US model. I mean, how's that going? What policies are they adopting, and is it getting anywhere? It sounds like what you're saying is sort of consumption is still quite low in China at the moment.
No, dual circulation, which by the way, we don't talk about so much anymore. It used to be you couldn't go a day without hearing it. Now you can go a month without hearing it. And it shows really the problem that China faces. Yes. The dual circulation argument is that there are two types of circulation. There's internal circulation, which mostly means consumption and investment, but in the Chinese context, mostly consumption, and external circulation, which means exports. And the dual circulation model said, what we're going to do is we're going to strengthen both, and we're going to use the strength of each to support the other. Well, that sounds good on paper. The problem is that China's export success, like that of Germany, like that of Japan, like that of all of the persistent trade surplus countries, arises from the fact that wages are lower relative to productivity than they are among the trade partners. Even high-wage countries like Germany, their wages are low relative to their productivity compared to other European countries. So your export success depends on repressing wages. But in all of those countries, especially in China, consumption is very low, a very low share of GDP relative to other countries. And again, for exactly the same reason. If you pay workers a very low share of what they produce, not surprisingly, they will consume a very low share of what they produce. So if you want to increase the consumption share of GDP, you have to increase wages. And if you want to increase the export share and increase the trade surplus, you have to reduce wages. So to me, dual circulation never made much sense. You couldn't do both. You could do one or the other. And in fact, that's what we've seen. I don't need to tell you that in the last 2 years, exports have soared and the trade surplus is on a monthly basis the biggest for any country in history. It's huge. But, and this is not a coincidence, everyone was really disappointed with consumption. Consumption today is lower than it was 2 years ago. The trade surplus today is higher than it was 2 years ago. That's not a lucky coincidence. That's exactly how it has to work. So I think that's why they've sort of stopped talking about dual circulation, and they now talk about the common prosperity.
So just following up on the idea of trade wars, I mean, I was in China in 2018 and 19, and it was Donald Trump was launching his trade wars, and then Biden obviously is the president, and he has not cut back any of the sanctions. But how do the trade wars or so-called trade wars between China and the US, how does that sort of play in? Because what you're saying is, despite perhaps Donald Trump's attempt to get China to buy more American products, in fact, the China trade surpluses continue to increase.
Right. The whole issue of tariffs, frankly, is a waste of time. Tariffs belong to the 19th century because trade was very, very different then. Trade was basically finished goods between countries or finished commodities between countries. Today, it's almost impossible for Australia to import anything that hasn't gone through at least 10 or 12 different countries. It's a very, very different system. So why does China run a trade surplus? The reason China runs a trade surplus, the reason Japan, the reason Germany, the reason the Netherlands, the reason South Korea, Taiwan, it's all the same. It's because wages are very low. As you'll remember from your macroeconomics, the current account surplus is equal by definition to the excess of savings over investment. If your savings are greater than your investment, you must run a current account surplus. It's the same thing. So countries with very high savings rates tend to have a persistent current account surpluses. And countries with very high savings rate are not countries that are thrifty. You know, you often hear the Germans are very thrifty, the Chinese, you know, they're Confucians are very thrifty. That's all nonsense. The reason those countries have high savings rates is because in all of those countries, the wage share, the household income share of GDP is declined. So people retain less and less of what they produce, so they consume less and less of what they produce. And so by definition, the profits of the business sector and government returns go up, and that's all saved. That's why those countries have high savings rates. So do tariffs change that? A little bit. Technically, when you impose a tariff, you are transferring income from your importers to your exporters. So it has a, a tiny impact on the distribution of income, but it's really tiny. If the US imposes tariffs on Chinese goods, that causes a tiny change in the savings investment relationship in China. But most Chinese trade is not with the US, so it doesn't really affect the overall imbalance. So China will continue to run a surplus with or without the tariffs, and it'll run the same surplus. On the US, by the way, like Australia, like Canada, like the United Kingdom, all countries with very similar financial systems and very high quality corporate governance, those countries end up absorbing the excess savings of countries like China, Germany, et cetera. That's why those countries run almost permanent deficits. Australia and Canada from time to time will run a surplus when commodity prices are very high, but basically they're all deficit countries. And the reason is because when you have excess savings, you need to put it somewhere. And the safest place to put it, the most flexible place to put it, is in the so-called Anglophone financial markets. Half of it goes to the US, and most of the rest goes to the other 3 countries. So as long as China has the savings investment imbalance, it will have a surplus. And as long as that money goes directly or indirectly into the US must run a deficit. So the only thing that tariffs did was they affected the bilateral trade. But, I'll tell you, my mentor at Columbia, Michael Adler, in his class on trade once said, if any of you ever mention bilateral trade, you will fail the course. His point is that bilateral numbers tell you absolutely nothing. You really have to look at the capital numbers.
So we'll go to questions in another 10 minutes, but I just want to perhaps throw a few different things at you. The role of the private sector, we've seen what's happened to Jack Ma, and obviously Chinese companies looking to list on the US or NASDAQ or NYSE. How's that playing out in terms of the economy? And, it looks like under Xi Jinping, the private sector has certainly taken a big step back. I suppose what you're saying is it's a logical thing, but where do you see the role of the private sector in the Chinese economy at the moment?
Well, I think there are 3 different stories here. One story is the political story, and that probably involves Jack Ma. And for obvious reasons, I prefer not to discuss it. The second story is also slightly political. My cynical Chinese friends say, if you expect a difficult economy ahead, you may want to put into place your sort of populist movements now. And so the attack on the private education sector, the attack on gaming, the attack on the rich, that's probably in that area. But those are small things. The real shift from the private sector to the public sector, I would argue, was sort of inevitable given the problems within the growth model. If you need a significant amount of non-productive investment to achieve at least half of your GDP growth, you can't rely on the private sector to do that because the private sector tends to invest productively. And if they don't, they quickly go bankrupt. So it's a self-correcting mechanism. If you don't invest intelligently, you will be blown out of the system and you will be replaced. So overall, the private sector tends to be pretty productive in its investment. But if you need people to build airports that aren't going to be used, bridges that aren't going to be used, if you've been to Tianjin, you know that Tianjin decided to become the financial center of China, one of the 20 cities that want to be the financial center of China. And it figured that, they went to New York and they said, New York is the financial center of the US. It has a lot of skyscrapers. So we know what to do. They built an entire Manhattan of office space on the banks of the river. And it's now a tourist attraction because you've got all these beautiful skyscrapers and they're all completely empty, right? The private sector can't do that. Only the public sector can do that because they have soft budget constraints. They have almost unlimited financing ability, at least up to a point. So what I argued many years ago was that under that system, you had to see a shift of the economy away from the private sector to the public sector. As long as you have a GDP growth target that is greater than the underlying growth rate of the economy, you have to see this shift from private to public sector within the economy. So I think that's going to continue until China begins the adjustment process.
Now, China's relationship with the world, those of us outside are wondering, are we seeing the Great Decoupling? Some people are comparing, I was in China for the Beijing Olympics in 2008, and some people are comparing 2008 with now, given the bookends of the 2 Olympics. And also China's adopting this zero COVID policy. And obviously this is meant to have zero COVID, but it does mean we've had 2 years of effectively closed doors of people being able to jump on planes and go back and forward. So just in terms of this sort of China's relationship at the moment with the rest of the world. I suppose if I be a devil's advocate here, are they effectively saying they want to be open, but effectively has the door to foreign investment, to foreign business, has it started to close?
It seems that way, you know, and again, it's something that I can't discuss too much. As we spoke about not so long ago, I'm very involved in the sort of independent music scene in China, and I find musicians are a really good weather vane. You sort of know what's happening a little bit before everybody else does by watching them. And you know, 6 or 7 years ago, it already became pretty clear that they were very, very nervous about saying anything that might be misinterpreted as unpatriotic. It became a really big problem. So we seem to be going through this sort of ugly nationalist phase, to the point where a lot of Chinese academics and intellectuals are starting to warn about it. But again, they typically warn about it right at their retirement age, because it's not good for your career to talk about this. But it's something that I think a lot of people are very uncomfortable with, and this will probably go on for a few years. You know, if you read the history of the McCarthy years in the US, that, you know, long after everyone knew it was idiotic, it continued going until finally, suddenly, it sort of disappeared. It never completely disappeared. But I mean, I think in China, we're going through something similar to that. Now, the COVID story is a little bit different. China has really committed itself politically, domestically, to the zero COVID policy. And that was probably a good thing for a while. But I think we're increasingly recognizing around the world that COVID may stop being a pandemic. It may be an endemic. We may just have to get used to it, just deal with it, live with it. And I think it's very, very hard for China to make that decision. A couple of doctors have suggested that. They've immediately, you know, everything has been deleted and they stopped talking about it. It's really not something you're supposed to discuss. But if the Omicron and the new variations of COVID spread so easily, it's very hard to imagine that they won't spread easily also in China, in which case the zero COVID policy becomes really, really hard to maintain. Now, this is probably the biggest risk for China this year. If we get a really rapid spread of COVID and they close down clumps of the country in order to maintain the zero COVID policy, then everything I said earlier about growth this year, I take it back. Growth will be very bad this year. I think it's unlikely, but it is a big risk. But one way or another, if the world ends up changing its attitude towards COVID and learning to live with it, then China has obviously two options. It remains completely closed, or it switches and follows the policies of the rest of the world. I think ultimately it will do the latter, but I think the latter is politically very hard to do, because so much of the prestige of the government has been in its control of COVID. And you know, every day in the newspapers and in TV, there are plenty of stories about how the rest of the world has totally screwed up on COVID and we got it totally right. It's sort of hard to change that narrative.
We've got some questions coming in, and if people can put them in the chat function, I'll ask them as they come through. Now, Edith Terry has taken up your point about dual circulation. If dual circulation was imaginary, what are the economics of common prosperity? Is this just another name for fiscal stimulus targeted at the social sector rather than infrastructure?
It's sort of a strange thing. A common prosperity, as you know, and Edith definitely knows, is they're using what they call tertiary distribution, which is in and of itself a weird concept. Primary distribution to households is wages and income and interest on their savings account, et cetera. Secondary distribution or redistribution is fiscal transfers. Tertiary distribution, which the rest of the world never really thinks about in the Chinese context, is donations from the rich to the poor. So common prosperity argues that through tertiary distribution, primarily through tertiary distribution, we will redistribute income in order to boost domestic consumption. And in a way that makes sense. Rich people don't consume their income. Most of them are too rich to consume everything they earn. It's the poor who consume their income. So if you take $100 from a rich person and give it to a poor person, automatically consumption goes up, which China needs more of, and savings comes down, which China needs less of. So in principle, it works. There's a couple of problems with it. One problem is that in the US, tertiary distribution is about 10 times the size that it is in China. And yet it's very hard to argue that tertiary distribution has eliminated income inequality in the US. Income inequality is now the worst it's been in 50 years, and well, basically since the 1920s. So even with high levels of tertiary distribution, that doesn't really seem to address income inequality. But more importantly, I see China as solving the American problem in China, or the European or the Australian problem, by which I mean that we all agree, I think most economists agree, that income inequality is a serious problem, that ordinary people get too low of a share of GDP in order to boost the economy through consumption, except with very rapidly rising household debt. So if you want to solve the problem in the US or in Australia or in Brazil or in Germany or wherever, the way you would do it probably is to transfer income from the rich to the poor, because households in the US account for 80% of GDP, businesses roughly 20%, and the government close to zero. What they receive minus what they pass on to the household sector is pretty close to zero. So most of the income is household income. And if you have an income distribution problem in the US or in anywhere in the West, you would solve it by redistributing household income, basically rich to poor. China is different though. China does have severe income inequality. It's a really big problem. It's as bad, it's probably worse than in the US. But that's not the real heart of the imbalance in China. The heart of the imbalance in China is that households only have about 55% of GDP, compared to 70 to 80% in much of the rest of the world, compared to 65% in low household income countries. China is way lower than the lowest. And of the remaining 45%, roughly half goes to the business sector. It's sort of hard to say what's business and what's government sometimes, but roughly half goes to the business sector, which is in line with other countries. And roughly half goes to the government, mostly local governments. So the real problem in China is not that the rich have too high a share of GDP. The problem is that government has too high a share of GDP. And if you want consumption to go up, taking from the rich to the poor will help at the margin. But even if income were perfectly flat in China, it would still be too low because of the very large government share. So what you have to do is transfer that government share. Right now, government revenue goes into investment. You need to shift that. Government revenue must either go back to the household sector directly or indirectly in the form of a stronger social safety net, et cetera, et cetera. But what it requires is a huge institutional, economic, and I would argue political transformation. And for me, that's the problem with common prosperity. It's solving the wrong problem in China. They're having real trouble addressing the right problem, which is the very high government share of GDP.
I have a question here from Kevin Hopgood Brown. How do China's population demographics impact the 5 options that you described at the beginning of your talk? Do lower birth rates and an aging population constrain future economic models?
Well, the demographics make everything worse. And, you know, I think what people forget is that China had fantastic demographics until quite recently. In the 1970s, the working share of the population was in the mid-50s, which is very low. And the reason is because you had a baby boom after 1949. So you had an awful lot of children, not that many working age people, not that many old people. And of course, as all those children came of working age, China's population grew, whatever, 1% or 0.5%. But China's working population grew very rapidly, about 1.5% or faster, until maybe 5 or 10 years ago, when the working age share of the population was in the 70s. Now in the US, it's in the 60s, it's in the low 60s. So that gives you a sense. China had a much worse dependency ratio in the 70s and a much better dependency ratio about a decade ago. So you had an enormous improvement in the working age share of the population and in the total working age population. And on top of it, you had all of these very unproductive rural Chinese moving to the cities where they became productive. So they had this spectacular demographic boom, which really helped them. Now that's all stopped. First of all, there's not that many people left to move into the cities. They want to continue urbanizing, but the really great days of urbanization are over. And secondly, the working share of the population is declining, but the total population isn't. All that's happening is that unlike in the 50s, unlike in the 70s, where you had an awful lot of kids, in 20 years, you're going to have an awful lot of old people and a working share population, probably in the high 50s. So very much like back in the 70s, except old people replace children. And that's going to be quite difficult because it means every Chinese worker has to support a larger population than today. So that's quite difficult. But on the other hand, what I always tell people is that demographic changes are quite slow. So I don't think this is going to be a crisis. I think it's a problem, for the whole China century concept, because today China has 5 times as many workers as the US does, but by the middle or the end of the century, it might have 2.5 times or even 2 times. It's a really dramatic change in the working age population share, even more dramatic than the total population. But it's a slow process. And what really matters in China in terms of the rebalancing and the health of the economy is the increase in the household income share. So if they can increase the household income share of GDP faster than the decrease in the population, and the decrease in the population is, maybe, I don't know, 0.5% or 0.25% a year, so they can easily do that, then you won't really see a problem in the Chinese economy arising from demographics. You'll see certain types of problems, clearly, but the underlying economic problem can be resolved by a rapid transfer of income to the household sector. If they don't do that transfer, then with or without the demographic problems, China's got a huge problem. I mean, they will do the transfer, right? But there are 3 ways you can do the transfer. One way is you can increase household income very, very rapidly, 6 or 7% a year, so that GDP growth grows more slowly, 4 or 5% a year, and you have a perfect outcome. No country in history has ever been able to do that. It's very hard to figure out how to do that. But there are 2 other ways you can resolve this imbalance. What I call the American way, which is what happened in the early 1930s, it rebalanced in the form of a crisis. GDP collapsed by 35% and household income collapsed by half of that. Brutal, but notice the US rebalanced. Then there's the Japanese version of the rebalancing after 1990, where GDP growth dropped from 5% to basically 0.5%. Household income growth was below 5% before 1990 and above 0.5% after 1990. So household income dropped only a little bit, which is why the Japanese never seemed very unhappy with what looked like an economic collapse. But the problem with the Japanese form of adjustment is over the long term, it is much worse for the economy. Crises are brutal, but they're short. That long, slow adjustment, which was the Soviet adjustment, the Japanese adjustment, ended up hurting the economy in the long term much, much more. But I would argue that those are the ways you adjust. So either Beijing takes very specific steps to shift income from the government sector to the household sector, which is politically very tough, but maybe they can pull it off. or the adjustment will be forced upon them, either in the Japanese way or in the American way. And I think we would all agree that China really would have real difficulty absorbing a disruptive American style adjustment.
Just on a personal basis, you have deal with students every day. You're in the music scene. They are relaxing the one-child policy. A lot of that's come off. When I've spoken to young people in China, they say, "Well, look, we can't afford another child. With the housing is too expensive. We're not living with the old days of living with mum and dad. We don't have." What do you see as the relaxation of the one-child policy? Is it making any difference? But what does that say about the mentality of some of the younger people, young couples who are essentially the future of any country?
Many countries have experienced this problem of an aging population and a slow birth rate. And so far, the only successful way to address it is through immigration. No one has been able to reverse the birth rate. And immigration is not going to work in China for a couple of reasons. First of all, I don't think very few societies are like the US or Australia that can absorb immigration. And even we have trouble absorbing it, but at least we know how to absorb it. Countries like China just have no experience doing that. And then secondly, the sheer size of China. I mean, they could absorb 100% of Vietnam and it would barely matter. It's quite tough to do. So I think that there's really nothing they can do about the declining birth rate. Certainly when you speak to, I've been here long enough that many of my former students are now in their 40s. And none of them has any interest. I have one student living in Singapore who has 2 kids. He's the only one I know with more than 1 kid. Most of them have 1 or 0. And they'll all tell you the same thing. See, one of the big problems in China, and they can fix this, but it's a very slow thing, is that there are over 1,000 universities, but frankly, there are a limited number that matter, right? There are the top 2 schools. Then there is what they call the Ivy League of 9 schools, including the top 2. And then you may have a bigger group of around 40 schools that are nationally funded schools. And below that, basically, it's crap, right? So in order to get your kids into one of the top 2 schools, it is a brutal competition, or not the top 2, top 40. It's a brutal competition. In the US, it's tough. And the US has a quarter of the population. Top 40 schools, very hard to get into with a quarter of the population. So in China, this is really like 10 schools in the US where everyone has to get into, and you can't. It's quite difficult. So as a result, if you have a kid and you want him or her to get into one of these schools, you've really got to spend a huge amount of personal time and a lot of money. It is really expensive to have a kid in school because you have a real arms war in the educational side. Now, they've tried to address this by banishing private sector tutoring. The problem there is that if the real problem is the lack of places in good universities, then you can fiddle all you want on the periphery, but you haven't solved the problem. And parents are going to do whatever it takes to get their kids into the top universities. So I don't really think that's changing. And I'll tell you something else that may be a little bit controversial, but one of the things, I taught at Columbia for many years, and I taught at Tsinghua and Peking University for many years. And one of the things I noticed is that almost all of my students have divorced in their early 30s. And, that's sort of, it really is, the divorce rate is incredibly high here. My theory, I'll probably get killed for saying this, is that I think it's the one-child policy. Because, I grew up with 3 brothers, and you fight and you learn to live with each other.
Yes.
But when you are a single child in a single child society and the entire world focuses on you, maybe it's not so easy to share your life and your home with another adult who also expects things to be focused on him or her.
Yeah, and Australia has actually benefited from this devotion of, you know, the two parents and 6 grandchildren, or how many I mean, we sell a lot of high quality baby food to China. Sure. Because those mothers, they've only got one child, and that child is going to get the best possible infant formula. Absolutely. Anyway, I've got some other questions coming in. We've probably got another 5 minutes to go. Edward Sillins has asked, what are the prospects for raising productivity? Is it just a question of improving capital allocation? Can robotics or human machine integration realistically raise productivity?
You know, I'm an old-fashioned, which I hope is starting to become in fashion again, an institutionalist. And the problem with being an institutionalist is that saying that it all depends on institutions is a way of saying we're not really sure. But I would argue that there are 2 different types of policies that boost productivity. In areas where the social and economic or educational, not economic, social, educational, political levels are high enough, where you don't have the capital, where you don't have the machinery, the roads, whatever, then the way to boost productivity is clearly to invest in capital. But it seems to me that rich countries are not rich because they have more bridges. They have more bridges because they're rich. And they're rich for some other reason, because they have a set of institutions, political, educational, legal, financial, cultural maybe, that allow workers to be more productive, workers and businesses. So if you take, you know, somebody from whatever, Ecuador, and move her to Spain, her productivity immediately goes up. She's the same person, but her productivity goes up. And it isn't because she now gets to work with the most advanced machinery in the world. She might just start a shop, but her productivity will be higher. And why is that? Well, we're not really sure how to quantify it, but it seems like rich countries have the right set of institutions that allow that to happen. And you'll notice, you know, some people, when I say that you've never had these very long periods of rapid investment growth without a significant adjustment, they will point to Germany after the war, Belgium after the war, France after the war. And to me, that sort of proves the point, because those countries were poor economically because their infrastructure was destroyed, but they still had the right set of institutions that allowed them to behave very productively. So as they invested and rebuilt their infrastructure, they were able to raise their economic level in a way that was permanent. Now, if this is right, and this is very much a Darren Acemoglu and James Robinson argument too, if this is right, then there were 2 stages to China's productivity growth. The first stage is when China was underinvested, invest, build factories, build roads, build subways, build everything. But if we've reached the limit of that, then it's not clear that more investment will lead to more rapid productivity growth. In that case, what really happens is institutional reform. And institutional reform is sort of an easy thing to call it, but it's really quite difficult to do. And it's hard to imagine, and this is certainly Albert Hirschman's argument, one of my favorite economists, it's hard to imagine that type of institutional reform without significant political reform. So I would argue that the easy part's been done, and now the hard part has to be done. And maybe that's why we have middle income traps. You know, the middle income trap is another economist phrase that means something happens and I don't know what it is, so let's call it a middle income trap. But maybe that's the explanation of a middle income trap. You need political, institutional, social, financial, et cetera, reform.
Look, we've got more questions, but we probably need to wrap it up here. But I suppose I wanted to end with, I mean, you've been in China 20 years, you know, you're analysing, do lots of deep dives. I mean, in, say, the next 5 years, are we going to see collapse of China? I mean, can the Chinese authorities sort of muddle through, or, I mean, where are we in, you know, is the Chinese economy in much better shape in, say, 5 years' time? Or is there risk of the debt crisis getting out of control and some, you know, the much predicted collapse happening?
Well, there's always a risk of a collapse. I think it's a very low risk, and I've always argued we're really unlikely to see a financial crisis in China. As long as they control the banking system, as long as the domestic markets are largely closed, and they are largely closed, they can prevent a crisis. What they can't prevent is some form of adjustment. So just to take one case, the value of real estate in China is about 350% of GDP, right? It is worth more than twice all the real estate in the US, even though the US has a 50% bigger GDP. And it's worth more than 3 times all the real estate in Europe, which also has a bigger GDP. So that tells us that either American and European real estate is incredibly cheap, which I think would be a very hard argument to convince people of, or Chinese real estate is incredibly expensive. It's worth far more than the real economic value of the real estate. And if it is, it could be by 150% of GDP or more overvalued. Now, overvaluation doesn't last forever. We have periods of overvaluation. We saw that in Japan when we were told it would never come down because that's not how Japan works. Turned out we were wrong. In Australia, I know you have a problem with real estate. It will come down eventually, one way or another. But the point is that on the way up, it creates all of this fictitious wealth, which gets subtracted on the way down. And that has a real impact on the economy. So I would argue that China can probably avoid a financial crisis, not 100%, but it's pretty unlikely. But it cannot avoid a rebalancing of the economy and a readjustment of all of that overvalued infrastructure and overvalued real estate. And so what I think we're much more likely to see is a Japanese style adjustment rather than an American style adjustment.
Well, thank you very much. I apologise to people's questions we didn't get to, but we have been talking for just on an hour, and Michael's been very generous with his time and his insights, which are very seriously grounded in a lot of experience. So thank you, Michael. Maybe we'll come back next year and see where we are after the Party Congress. But thank you very much for your insights and giving us your time today.
Thank you, Glenda. Thank you, David. And thank you, everybody else. Bye-bye.